default rate for BBB rated is actually at 0.49%. So actually not as high as what I would have thought, given that if I think about like 2008 and it being a very negative period in terms of global economic growth, what we have seen for investment grade bond, which is this BBB column, is that the default rate is actually still at a relatively low level. So this helps to answer some of the questions around the risk part, in that while it is not something that is capital guaranteed, but when we look at the historical numbers, which is what we always look at, which is data and what the effects are telling us, the historical default rate has been relatively low. I think the next question that always comes out would be around the time period of investment. So I think it is good that some people are starting to ask these questions. And I think this was a point that was kindly highlighted by one of the people within our Telegram group, which says that actually for investing, what we need to think about is also the time duration of our investment. Because, for example, when we look at the 6-month T-bill, it is important to know that it's only for 6 months that we are locking up this interest rate for. And hence, I guess it is interesting to put up this chart on the right that you see. This is number that is provided by the MAS, showing what the yield is for different bonds that are issued by the MAS. So what we see here is that 6 month, 3.95%, so quite close to what we see in the market. But what is interesting to us here is that if we look further down the yield curve, for example, something like a 5-year, effectively is much lower at 3.33%. If you look at, say, 10-year is at 3.49%. So I think this goes back to the point around what time period that we want to be locking in the interest rate for. Because effectively what the MAS data is telling us is that the high interest rate that we now see for the 6-month T-bill is probably something that is peculiar to the yield curve. It's something that is available for 6 months or maybe slightly longer than that. But if you look longer out to, say, a 5-year period, then based on what the MAS bonds are telling us, effectively, we are not able to get as high an interest rate over a longer period of time. The other question that we get very often is around, what's our expectation in the interest rate outlook? Okay, so we have certain view towards the interest rate outlook, but we thought it is actually useful to share what the US Federal Reserve has put out officially as a forecast. And I think this chart is something that we always point to investors, because effectively what a lot of investors are now looking at is what the Fed is doing. Whatever they say overnight that drives the market the next day, what interest rate decision they have coming out in December can lead to very significant movements in the stock market, in the bond market. So based on what they are forecasting, what we see here is that yes, there's still some scope for interest rate to go up, and that will probably happen in December and early part of next year. But what is interesting is that by later part of next year and into 2024, based on their latest forecast, the interest rate is actually expected to start falling. So that once again ties in with what we have seen previously for the Singapore bond curve, where that while the interest rates are high at this point in time, based on what the Fed is currently forecasting, the interest rates could potentially fall over the next 2 to 3 years. And that is something that investors should be aware of when making some of their investment decisions. So I think in summary, those were some of the questions that we have been commonly getting in our Telegram group, which is really how do we lock in interest rates? How do we look at different products that are out there in the market? And what is really the interest rate outlook that we might have? So I'm not sure about you, Henry. Do you have any thoughts about where interest rates might be heading towards?
Yeah, these are very good questions, and we get that a lot too. I've actually prepared some. You see, I'm not so professional, so I've actually prepared some crazy slides again to demonstrate this point. And if you could give me a couple of minutes, let me take you through that. Let me share my screen. 1 second. Let me share my screen. Okay, very simply put, why interest rate cannot stay high for too long? I'll make it very fast. Now, okay. Now you see, the only tools that Fed has today to fight inflation, or in fact to fight anything at all, whether it's COVID, whether it is subprime, or whether in today's case extremely high inflation, is really just to increase interest rate. That's all they can do. Interest rate, money supply, nothing much. And what I'm trying to show here is this, right? As they start to decrease money supply and increase interest rate, what's likely to happen is inflation is really a house of cards. When it starts to fall, it doesn't fall halfway and it stops, right? More often than not in the past, what we see is they fall. So you have interest rate increasing. And then next thing you know, very clearly, you have unemployment rate increasing. And then you have bad housing numbers coming up. And then you have slow growth. And once you go down this slope, it's a very slippery slide. Then you end up in a recession. So we've been all talking about, oh, it's a recession coming next year. And what happened in a recession is you have deflationary pressure, right? When there's a deflationary pressure, what will Fed have to do? They will have to reduce interest rate. So in my mind, well, we all agree, me and Gerald has agreed that interest rate will come down. Now his time frame is 2 years, 3 years. My time frame is probably somewhere in the next 12 to 18 months. But directionally, we are all in alignment. And so is the market. The market has been talking about, is there overcorrection? Fed has come out and say they are not allergic to having a pause, right? Now, and see, having a pause, having a correction, overcorrection, how does this happen? Very simple. The yellow box here shows what the Fed can control, right? They can control interest rate, they can control money supply. Now, what they cannot control is inflation at the other end of the seesaw that we see here, right? What can they do? They up interest rate, they decrease money supply. Company growth starts to slow down. When companies start to slow down, this is not something that they can control. Fed cannot make a company grow faster. So things starts to move. Jobless numbers starts to increase. Again, this is not something that Fed can control. Fed doesn't go to Facebook and say, hey, you need to hire back the 10,000 people you fired. They can't do things like that. New housing numbers starts to go down. Again, if Fed wants to keep interest rate high, they cannot go to people and say, I need you to buy a house. It doesn't work that way. So all these numbers in the white boxes are numbers that Fed actually cannot control, but is directly an effect of moving interest rate up, of decreasing money supply. And then the biggest thing here, you've got to reduce consumer spending. Now, when consumers stop spending, that's when you have a multiplier effect in your company growth, you have a multiplier effect in your jobless number, people stop buying houses, stop buying new cars. That's when your economy will collapse. You go into a recession. And this is what we call an overcorrection. In Chinese, we call it 杀鸡用牛刀, right? If you want to kill a chicken, you don't need a buffalo knife. Now, but why is this happening? Very quickly, I just want to leave you with a couple of points. See, number one is, I always like to use this analogy. When Fed says they want to engineer a soft landing, how do you actually engineer a soft landing? It's almost like asking a pole vaulter to jump across the barrier and land on a coin. It's near impossible, right? And if you look at some of the quotes that I fished out from the internet, this guy called Greg Mankiw, now he used to be a economic advisor for George Bush Jr., right? And his words, steering the community is like steering a large ship. It moves very slowly, and then once it starts, it keeps going. You can't stop it. So any of you who has tried steering a boat, you realize that one of the tests to get a boat license is how to park your boat, and that is often where people fail, because even at that speed, when your boat starts to move, you cannot steer in the right direction to park the boat properly. And that is essentially what the Fed is trying to do. They are trying to steer the boat now. It moves very slowly, so they keep increasing interest rate. Inflation rate keep increasing as well. Now, the moment inflation rate starts to decrease, that doesn't mean that is the right interest rate. The right interest rate should be somewhere below, and that's what we mean by overcorrection. And that's when you'll see interest rate tip over, like what you see in Gerald's chart earlier. Right. Milton Friedman, those of us who have done management in uni, you have come across this name quite frequently. He wrote a few books and added a few chapters to our exam. He came out with this analogy, a fool in the shower. Okay. And it says the expression is best summed up as a scenario where central bank or government overreact to swing in the economic cycle and loosen monetary policy, fiscal policy too far, too fast, without waiting to gauge the impact of their initial action, right? And it's like a fool. When you go into a shower, you turn on, you realize, oh, water is quite cold. So the next reflex action is you turn on the hot water. Now the hot water is going to take a while to come, right? My house is very small, but even there it takes about 15-20 seconds to come. What you're likely to do is you're going to turn even more hot water, so that the hot water will come faster. Eventually, when the hot water comes, it's so hot you scald yourself. And that again is another very good example of what the overcorrection is. And to me, that is where I think our economy is today. Right. I just want to quickly share another slide, if you will allow me. 1 second. Yep. Now this is the screen that talks about our product. I will skip a few of these, but now Gerald and us, we didn't produce our slide together. It was separately done, and then we put together just about 30 minutes ago, and then we realized, hey, there's so many touch points that's the same. You know, T-bills. This is in business times, right? T-bill investor needs to be aware that if yield starts to decrease, right? And my earlier slides already tell you yields will decrease at some point of time, right? You will find yourself reinvesting at a lower rate. And that's the beauty of United Fixed Maturity Bond Fund, because it is going to lock you up for the next 3 years, lock up the interest rate it is today for the next 3 years. So you don't have to worry about reinvestment risks. Okay. Now, I just want to share this slide. Now, look, nobody in the world today can tell you where interest rate will be, right? We can all try to read a lot, and then hopefully from our past experience, put together something that we think is going to happen. Will it happen? Will it not happen? We don't know. But these two charts here is taken from the Fed Washington website, right? Now, in the Fed Minute, all the various jurisdiction members are always asked to, in a plot chart or a scattered graph, to show where they think interest rates should be, right? There is two rates here. One is Fed fund rate, which Gerald covered earlier. One is a 10-year Treasury rate. Now, most of them thinks that 10-year Treasury is going to be about 3.5%, right? Today, your Fed fund rate is already more than 3.5%. So you're having a sort of like an inverse yield curve. Now, that is not a natural curve. At some point in time, the curve must go back to this way, where the longer you borrow, the more you have to pay, right? And they think this end here is 3.5%. Okay. Now, if you look at the chart on the left, the Fed fund rate, it's about 2.5%. So most people, again, most of these people are thinking that probably in time to come, rates will be around 2.5. If you look at this part here, that let me try to highlight here, you can see that the rates are actually turning downwards, right? And it's turning downward because overcorrection. They have overcorrected, and they need to tune the rates down so that your 10-year can stay at 3.5. Right now, if your 10 years goes to 6%, the economy is gone, because what it means is it will be too expensive for company to borrow, right? And when company cannot borrow, they cannot grow, the economy will be a standstill, right? So interest rate high is only good if you are a lender. If you are a borrower, it kills you. Now, interest rate low, why is it not good? What's going to happen is company is going to borrow tons of money to expand, like how we see in the last couple of years. And then you're going to run into an inflation problem again that we are facing, say 6 months ago, right? So ideal interest rate is always somewhere in the middle, about 3.5%, right? And I just want to regurgitate this. This is not an analyst report. This is not anything. This is taken straight from the FOMC Washington website. Okay. And I want to leave you with another very quick slide. You see, half my life I'm a salesman. So if you do buy this fund, the United Fixed Maturity Bond Fund 1, you need to realize that you can only buy it through Tiger Brokers. This is an exclusive launch between Tiger Brokers and UOB Asset Management, right? A couple of features in there. Number one, you are looking at approximately 14.85% yield after 3 years. You are looking at things like zero management fee. I do believe that is probably this is probably the only fund in Singapore that's got zero management fee, right? And on top of that, Tiger Brokers is going to give you another 15% of cashback for 10 days. What it means is this, right? If you put in 10,000 today, 10 days later, you'll find that you have $41 more in your account. And all this is completely unasked, right? I just want to leave this thought with you. A few things I want to summarize from what Gerald and I have been speaking. Number one, the bond fund or bond exposure is perhaps something that we all should have in our portfolio. And today is a good time to buy bonds. I mean, bonds will not be performing in the last, say, 12 months because interest rate has been increasing. The price will fall. Now, today you'll buy it at a below par. And when the bond matures, not only it represents that you're going to get interest in between, but it also means that you're going to register a big chunk of capital gain. And that's how you're going to get a 14.85% over 3 years, right? Thanks, Gerald. Thanks for joining us today. Maybe let's just take this time to answer a couple of questions. Let me see. Okay, so Richard is asking this. If I need money urgently, how fast can I redeem? Is there any penalty? I think it's a very good question. Okay, this fund has got weekly liquidity, and once you choose to redeem, every Friday there will be a NAV released, and 3 days later you'll be able to get your money back, right? So whenever you decide to redeem on a Friday, you will get an NAV that will tell you how much you're going to get back, and on Wednesday you get your money back, right? Is there any penalty? Unfortunately, there is. Why? Because this fund is a portfolio of bonds. Now, when you pre-term your bond, you actually lose the yield to maturity, and along with that, many other investors also lose their money together with you. So because of that, we will have a penalty of 2% for anyone who don't hold it to 3 years, right? And I want to assure you again, the 2%, 0 cent will come to us in Tiger Broker. Nothing will go to UOB AM. It is really meant to compensate your fellow investor in this fund, right? Okay, Eugene says SSB and T-bill have an interest of 3 to 4% with investment grade AAA. Proposed return of 4.95%. What is the investment grade of the lying asset in UOB? Is this a proposed return fixed or variable? Okay, let me take this question as well. And Gerald, please chip in if you think I am not doing such a good job. Right. Indeed, SSB and T-bills are paying 3 to 4%. Now, SSB is ultra long term. You've got to hold it for 10 years, right? Sure, you can redeem halfway as well, but you know the step up happens every few years. So if you redeem halfway, you may not get to enjoy the full range of the yield that is promised to you. T-bills, on the other hand, are typically ultra short period. And then I want to bring us back to the question or the slides earlier when we talk about reinvestment risk. What you realize that if you invest 6 months, excuse me, you might be lucky. You can roll over another 6 months at high rate. But perhaps the next one you roll is going to be at 2.5%. So if you roll that for 6 times, which will give you 3 years, you actually may not get 4.95%, right? The following question is, what is investment grade of the underlying assets in the fund? It's a whole spectrum. It ranges from govies, which are government bonds, all the way to corporate bonds, AAA to BBB minus. And this is done in such a way that your risk is diversified. Right. Now, AAA default is almost unheard of. In my life, there was only one AAA company that went bust, right? Even at BBB, your default rate is 0.4%. Now, and that is why, because of this 0.4%, you're actually paid 95 basis points more than the AAA bond. So the question you got to ask yourself, is it worth losing 95%? Because I want to take 0.4% of risk off the table, right? So that's something you got to think about before you put your money in. And the third part of your question, Eugene, is the proposed return fixed or variable? Okay, the returns comes in 2 forms. The first form is every 6 months, you will receive a coupon of 3.5% annualized. Now that's fixed. You will always receive it every 6 months. Now, at the end of the year, end of 3 years, you will receive 3 cash flow. First and foremost, you will receive the last installment of 3.5% per annum. You will receive your capital of the bond, which could be $93, $94, and you will receive the capital gain of your bond, because your bond will always mature at $100. And today UOB is buying these bonds at below $100. Now, it's the capital gain plus the 3.5% that will give you a 4.95%. So unfortunately, I have to tell you 4.95 is something that is not fixed. It could vary, but looking at today's interest rate, I think there's a high degree of certainty you can get that. How it's going to be determined is at inception, when they buy all the bonds, we will know what's the return going to be at end of 3 years if there's 0 default, right? And I hope that answers your question, Eugene.
Maybe I will add on a bit to that. Not that you didn't do a good job explaining, but I thought maybe some numbers that we have often been sharing with the Beansprout community as well would also be helpful, because we get this question around SSB versus T-bill versus fixed deposit all the time. So it's something that we have constantly shared with the community. I think the first thing, like you mentioned, we need to look at the time horizon of the investment. So for example, the T-bill, while the rate now is about 3.9% per annum, do remember that that's only for 6 months. Unfortunately, there isn't a 3-year T-bill. So even if you want to lock it in at 3.9% over the next 3 years, we can't actually find a T-bill for that. We have to look at the SGS bond, but again, the SGS bond, we don't actually have a 3-year issuance. If you look at the Singapore savings bond, where like Henry mentioned, you can have the interest rate for the next 10 years. If you look at it from a 3-year perspective, the interest rate isn't at 4%, it's closer to about 3.3%. So I think it goes back to the point, which is something that we always share with our community when thinking about investing. It's always around the risk reward. Okay, because for investing, that's what we always think about, what kind of returns we are able to get versus the risk that we are taking. So if you compare the return for the United Fixed Maturity product now, indicative yield of 4.95% per annum, that is already higher than what we are able to get for, say, the T-bill or the SSB. And then next, we can look at the risk. And I think based on what we shared earlier in terms of the default rate, based on what S&P has actually shared, then the historical default rate is actually less than 1%. So hopefully that would provide some statistics when we are thinking about the risk reward when making any investment decision.
Thank you. I'm pretty sure you explained it a lot better than me. Now, next question, and a couple of other questions that came on. The IOP period unfortunately cannot be extended. Interest rate environment is changing very fast, and Gerald earlier has mentioned that in fact, if you look at T-bills, it is coming down. So we do already have people in the pool, and we want to lock in their rate as quickly as we can. So I will strongly urge you, obviously you need to think about it, but do take note that this fund will close 28 morning 11 a.m. So do punch in your orders. And how to punch in your orders? If you're already a Tiger Brokers customer, turn on your app, right? At the bottom, go to quote. And from code, you will be able to find on top, it says there's this tab that says fund. Tap on fund, scroll down slightly below, you will see a thing that says United Fixed Maturity Bond Fund 1. Let me just, if I could, just quickly share my screen so you can see where you can see this. 1 second. Yep, here we go. Hang on. Okay, as I mentioned, turn on your Tiger Brokers app, right? The code tab is here below. Once you tap on it, you will see that on top, there's another tab that says funds. Again, when you tap on it, somewhere in the middle, you'll see this thing, United Fixed Maturity Bond Fund 1. Click on subscribe and punch in how much you want to invest in it, and then and that's it. That's all it works. Very simple. Okay. Let's just look at some more questions. I think we have about another 5 minutes or so. Okay, this is slightly confusing, but let me attempt. And again, Gerald, if I don't do a good job, please help me here, right? Now, say a bond is a 5-year bond, and then it will always be always issued at $100, right? Say at that point of time, interest rate in the market is 1%. Okay. Now, as interest rate move up, the price of the bond will start to come down, and vice versa. If interest rate comes down, the price of the bond will start to move up. This is called an inverse relationship. Okay, so if you look at what happened in interest rate over the last 6 to 10 months, you realize interest rate has been going up. So a lot of these bonds that has got 3 years left, their price will be below 100. Let's call it 95. Okay, because the interest rate has been going up, the price comes down from 100 to 95. And this is how the fund will work. The fund manager will buy the bond at $95. Now, this $95 bond is still going to pay you a fixed coupon, which will be paid to you every 6 months, of course. And this bond eventually at the end of 3 years will have to go back to $100. All bonds will mature at $100. Now, so what it does is when you hold on to this bond, you will earn a string of coupons. And at the end of the year, you actually get back $100 for the $95 you put in. And the $5 extra here is your capital gain. Right. So SWM, I'm not sure if you are male or female. I do apologize for that, but I hope that answers your question. Thank you. Will there be a bond fund series 2 or 3, perhaps with a different maturity? We will look at it. We can't give you an answer now because when we issue a new product, there's a lot of factors we looked at. And is this product going to be something that's beneficial to investors? And if it does, we cross the road and talk to our partners again and try to put something together. So yes, we will look at it, but at this point in time, I can't promise you that the stars, the moon, the sun will be aligned for the next issuance, right? Will there be any other similar products available in the future? Again, I can't quite answer that question today. All I can tell you is we will try, and we try our best to always bring best product across to our customers. But whether is it good, it depends on a few things. Number one, what's the market environment? And number two, is this a product that's suitable to you or your portfolio? But I want to encourage you to stay tuned to Tiger Brokers, join our webinar. We often have new products launched, and we're happy to help you, right? Okay. Okay. SWM has a follow-on question. If I only invested 10K initially and hold to maturity, I bought at 100. It becomes 95. I didn't sell it whatsoever. How can I benefit from 95? No, it doesn't work for this particular bond fund. It doesn't work this way, right? You will invest 10K initially, for example, but you will be buying bonds not at 100 but at 95, because these will be bonds that's already been issued. These are not new bonds, right? It will have already been trading at 95 because interest rate has gone up over the last 10 months. So the price has already dropped to 95. I will buy them at 95. And then at the end of 3 years, when this bond matures, it will mature at 100. And you will get the $5 capital gain. I hope I answered your question. Please let me know if I don't. Happy to take further question. Now, is there a purchase limit? Try me. Punch in whatever you want. There is a limit, unfortunately. We do have a limit on how much we can issue, and simply that's because there's also a limit to how much bond I can buy in the market at below par. If I buy it above par or at par, then it doesn't, the target return doesn't materialize. So there is a limit, but let's see what we can do. Put in what you want, and we see what we can do. Right. Thank you, SMW. Thank you very much. Okay. Another question: if Tiger users close their account, what happened to their UOB fund? Auto terminate? No, it doesn't. It doesn't. If you close the account, you can obviously choose to transfer this fund elsewhere. So if you decide to close the account, there are two choices. Number one, you can redeem the fund. However, earlier on, I mentioned that there will be a 2% penalty. But if you choose to pay so, you can redeem the fund. Alternatively, if you decide to take your business elsewhere, which will make us all very sad, you can actually transfer this fund to your new broker, and they will be able to custodize it for you too, right? Okay, sorry. SMW has a follow-on question. Is there any way to know how much does the fund manager bought? How much does the fund manager bought the fund? I presume you're asking how much does the fund manager bought the bond at, right? It's a bit tough because it's made out of like 30. We are targeting at least 30 bonds there, so it'll be a mixed bag of different prices. But collectively as a portfolio, we can at a point of inception know what's the target return at the end, and that will give you an average price of the bond that is being bought within the portfolio. Okay. Why is the fund focused only on Asian region? Good question. Asia is a very peculiar area. Number one, credit of the same rating between, say, Singapore and in US, or Malaysia or US, or Korea and US tends to pay more, right? Like, let me give you an example. If you look at Korea, Korea is actually a very safe country. They have got plenty of good industry, but because they have also quite an unfriendly big brother upstairs, market tends to price their credit a bit more. So in another word, right, I can go to Korea today and buy a AA bond, right, that pays as much as a single A bond in the US. That's why Korea is always a bond investor's favorite location. I can go there and buy a single A bond which pays as much as a BBB bond in US. And obviously, Asia is going through this time of growth where there are plenty to choose from, right? And that's why the focus is also on Asia. But bear in mind, there are going to be about 15, 18 countries within this portfolio across different sectors. So the other reason why it's a region focus is because of diversification. All right.
Maybe I will just add a bit to that. So I used to be a sell-side analyst, and I think in terms of how a lot of all these fund managers might work, at the end of the day, is something that we discuss, which is always think about the risk reward. So I think based on what Henry shared, it's about whether we can find bonds with relatively low risk, and that we can look at it as to whether it is rated as being investment grade. If we are able to find such bonds within Asia that are seen to be relatively low risk, but still giving the bondholder a relatively good return, then I think that might be the reason why the bond fund focus is actually on Asia, because of the opportunities that are being presented that might offer a better risk reward compared to potentially owning the bonds that are domiciled elsewhere.
Good point. Good point. Okay, very quickly, I will take the last three questions. There's a little bit of time overrun, but if you still got questions that you need answers to, do approach Tiger Brokers. We'll be happy to answer them, right? First question here, can my financial advisor help me to purchase this fund? The answer is yes. We are working with 5 financial advisors. If you go to the landing page for this fund, you will be able to see all of them. But I'll just quickly recap some of them. Sing Capital, PFPFA, Financial Alliance, Manulife Financial Advisor, and Infinitum. These are the 5 FA firms that are working with this. And I'll tell you what, if you go to them to get them to help you, they might have some special gift for you. And I guarantee you'll find it very attractive. Check them out as well if you think that you need financial advisors' help. Now, if you don't have a financial advisor and you would like us to help you talk to someone, again, feel free to drop us a note. We will link you up with someone, right? Now, SWM has a follow-on question. Thank you very much. Will the fund manager disclose their bought price elsewhere? Can I still add money into the fund after I already subscribed 10K during the IPO? I'll answer the second part of the question first. Once the fund is launched, you will not be able to buy it anymore. It's a closed-end fund. So once you hit 28 morning, 11 a.m., the fund will close. That's it. You are in a special club that nobody else can join anymore, right? So the answer to your second part is no. Will the fund manager disclose their bought price? It's not likely, right? Because at a per bond basis, it's a bit too confusing to be releasing all the numbers. Now, however, from a portfolio basis, you will be able to work out what's the average price of each of these bonds that's being bought. Okay, and WLC previous webinar shares that there's an overweight on Korea region at 30%, but there's also news of concern on corporate bond crisis in Korea in October. Any concern of default? Very good question. Very good question. Now, let me first explain why we always overweight Korea. Because Korea is a place where you can find similar grade of bond paying higher than what it should be paying. And that's because of the political or geopolitical issue that they have that nobody else has, right? And that's why everyone loves to buy Korean bonds. Because if I want to get a double A risk, I'm still exposed to a double A risk, but I get paid more than what double A risk would supposed to give me. So everyone likes Korea for bond investment. Now, is there any concern with corporate bond crisis in Korea? Now, frankly speaking, I won't be too concerned, and I'll tell you why. Because the whole market could be crashing, but if I'm a double A rated by S&P, I'm a double A rated by S&P, right? It basically means that I'm a double A, I have ways to refinance, and that's why I'm a double A, right? So in my previous life, my CEO used to use this word called a canary in a coal mine. A company issues a bond because the credit spread of the bond is essentially a canary in a coal mine. So when you go into a coal mine in the olden days, you bring a canary along with you. If you walk halfway, you see the canary died, you better run. That's what the bond thing is about. But having said that, bond always gives the earliest signal on whether a corporate is failing or not. And actually, I would not be looking at a crisis like this to determine if it's safe or not. The first thing I'll look at is actually the credit spread of the particular company. And that's the best telltale sign there is out there on whether a company can survive or not. But I'll still fall back to the S&P rating. I mean, these are highly rated companies. They already say that this bond is AAA, and it will be AAA. If they say this bond is BBB, it will be BBB. And the risk of holding that in Korea versus the risk of holding that in Singapore, in Malaysia, or in anywhere else in the world, it's the same risk that we are holding, or same level of risk that we're holding. Okay, I hope I answer your question. Gerald, anything to add from your end?
Yes, something that I learned from attending the seminar earlier. So I think that is one of the advantages of having the fund being professionally managed by good fund managers. Because while the idea is to hold the bond fund till maturity, the good thing about having a fund manager helping you to look after this bond fund is that if there are any of such developments, if there's something that would have changed drastically, there's still the option for the fund manager to potentially adjust the portfolio to be able to achieve the target return. So I think that goes back to whether we believe that the fund manager has got good reputation, what is their track record, because those are the things that we can look at to determine whether we actually want to be buying into the fund and whether the fund can achieve the indicative return that is actually being shown to us.
All right, thank you very much, Gerald. Thank you. And to all our lovely audiences, I just want to repeat one point. Turn on your Tiger Trade app. At the below, you see a code. Click on it. Go to the top, fund. You'll be able to find UOB Fixed Maturity Bond Fund 1, just slightly below there. Tap on it, go to subscribe. You'll be able to punch in how much you want to invest in this fund. The fund closes on the 28th morning, 11 a.m. So please be sure to put your orders in And again, to regurgitate the promotion that we have, if you buy during this IOP period, you get 15% cash back, which means after 10 days, every $10,000, you get another $41 in your account. How sweet is that? All right, thank you very much. We really appreciate you taking time to join us here today, especially number one is Thanksgiving. You might really want to actually eat dinner with your family instead, so we appreciate that. And number two, Switzerland is playing Cameroon. Switzerland was leading when we started the call. I hope they are still leading. Right, happy Thanksgiving, happy World Cup. Thank you.
Thank you.